Next, we look at how to prepare what's called the Statement of Owner's Equity. Now, I have some good news. This statement format has not changed since Chapter 2. This statement still shows the change in the owner's financial interest from the beginning of the accounting period until the end of the accounting period. It shows the owner's beginning capital. It would show the net income or net loss, which came from the income statement, and it shows any withdrawals made by the owner during the course of the accounting period. You compare your net income against your withdrawals. Depending upon which is greater, we will either have an increase or a decrease in capital. For this illustration, which number is higher? Yes, the net income is higher. Therefore, we have an increase in capital for the difference of $23,358.20. Because you have an increase in capital, we're going to add the increase to our beginning capital balance to get ending capital of $84,579.20. This is known as the Statement of Owner's Equity. Now, what has changed is the format of the balance sheet. We now have what's called a classified balance sheet. When you think of a balance sheet, you should still think assets, liabilities, and owner's equity. Except now you're going to have different categories of assets and different categories of liabilities. First, on the asset side, we have what's known as current assets. These are assets in the form of cash already, or items that normally we can convert into cash within 1 year, or items that will be used up within 1 year. So read the definition and think about it. So again, these are assets consisting of cash or items that we convert into cash within 1 year, and items that will be used up within 1 year. So first think about what type of items can we convert into cash? I'm glad you asked that question. Those would be your receivables, whether no receivable, account receivable, interest receivable. These are items that we can convert into cash when the client pays us. Also, merchandise inventory. Once we sell the inventory, then it becomes receivable and eventually converts over into cash. Prepaid expense are items that we are going to use up, typically in a time frame less than 1 year from our balance sheet date, such as supplies, prepaid insurance, prepaid interest, etc. So these are items that we are going to use in a time period of less than 1 year from our balance sheet date. So we're going to list all of our current assets. Notice that you have the allowance for doubtful account, which is a contra asset account. It's subtracted from account receivable to get your net accounts receivable. We'll add up all of the assets, including the prepaid expenses. The current assets total $98,716. Every section of the classified balance sheet will have its own subtotal. So current assets are $98,716. Our next category are called our plant and equipment assets. These are known as non-current assets, also called long-term assets. When you think about these assets, these are tangible assets that are being used by the business to earn revenue for a time period longer than 1 year. Excuse me. So again, your plant and equipment assets, these are tangible assets that are being used by the company for a time period longer than 1 year to help earn revenue for the business organization. So you think about your equipment accounts, your machinery, your automobiles, building land. Most of these accounts go through a process known as depreciation. So next to each of these plant asset accounts, they'll have a sub-account known as accumulated depreciation, which is subtracted from the original cost to determine the current book value for these plant and equipment assets. So now we're going to get a total of all of our plant and equipment assets, and they total $31,900. Go back. To get your total assets, we'll add the total of our current assets and our plant and equipment assets together to get total assets of $130,616. Okay? So we have a partial balance sheet. This section is showing the total of the assets section. We'll now move on to the section known as current liabilities. When you think about current liabilities, these are debts or obligations that will become due within 1 year from your balance sheet date. Again, these are debts or obligations that will become due within 1 year from your balance sheet date. So we list all of our current liabilities, get a total. They total $46,036.80. Again, recall that every section on the classified balance sheet must have its own subtotal. Next, we have what's known as long-term liabilities. These are obligations that will become due longer than 1 year from the balance sheet date. Again, if it's a long-term liabilities, these are obligations that will become due in a time period longer than 1 year from your balance sheet date. Examples are mortgage payable, notes payable, loans payable, or examples of different types of long-term liabilities. So on the, did we not show those? Wait a minute. I'm sorry, somehow I skipped that. Now I skipped that section, but the long-term not shown. Well, actually, this example here did not have any long-term liability. That's why I'm not showing any. But if we did, they would be shown on their own section of the classified balance sheet. The last section of the balance sheet would be our equity section. And this section only shows one account. It shows the owner's ending capital balance, and the ending capital amount is coming from your statement of owner's equity. So that amount is transferred over to the equity section of the classified balance sheet. So when you put it all together, and I don't necessarily have one on here all together, but you see total assets were $136,616. We only had current liability of $46,036.80. We didn't have any long term for this example. We had the equity of $84,579.20. So the balance sheet still has to balance. Our total assets must still equal our total liabilities and owner's equity. Okay? That will conclude our Chapter 13 lecture on how to prepare what's known as a classified balance sheet.